Okay, good morning. It's Sunday. I've been getting a lot of questions on the different things that I'm doing, the different alerts that I'm sending, the different strategies that are might be confusing to some beginners, and I wanted to make this video to kind of have a general explanation of what things mean, how to go about them, and then just a general overview of the strategies and what a setup buy is and what a strangle is, a butterfly, how to put the trade on, and what does it mean. Um, it's gonna be. I'm gonna try to be not to be too long in this video, but if you have specific questions that I'm gonna go a lot more in depth on each and any of these topics, please ask me. I can really cover a lot more, but it'll be just too long of a video. So I wanna make it as concise as possibly can of what you're seeing on the alerts and what I'm writing, so you can kind of have a better understanding, and then also like actual execution wise, so you can see how to go about it in the broker account. How do I do it? How do I put the trade on? So okay, I'm gonna start with the basics and then kind of build from there the different strategies. Basic buying a stock. Again, this is the Nasdaq. This is kind of what I'm looking at. I covered this in the market video yesterday. Um, Again, I'm thinking this weekend we're gonna have another down day. I mean this Monday because everything is going on. So we'll see. Might have to take some losses on the positions that I currently have, but minimize the risk. Okay, so for example, let's go to a stock that I was looking at, and then what I mean about a pivot and an entry point, and then how to go about executing the trade. So on this chart, you have multiple bases and entry points here. So you can go all the way back here, like for example, back here in January when it was trading, when it went to this high, I would have drawn a trend line right there and waited for all this to happen, and when it came back, I would have bought it right there. That would be the pivot. So this when I say the pivot, that would be the pivot on top of a trigger point on top of a base. Another little base, it could have been like right here also. You have a little shelf right here, a little cup within a bigger cup. You could have had an entry right there. So here, this high, you could have an entry right there. On here, look how beautiful. This came in here, no entry, no trigger. You came back in again, that would have been a trigger. In here, that would have been a trigger. In here, that would have been a trigger. And then here, you had to wait from September all the way to like recently to get this entry point right here, but you would have avoided all this drama and all this mess. I mean, if you wanted an earlier entry, probably enter right there, but you would have been stopped out there. Or here, you would have maybe entered right there, and it took off on you. So that's what I'm looking at as far as entries. Okay, that's the pivot. The pivot will be the price movement above my trend line, my base. This is the base. This is the pivot. Nice little cup here, an entry. Nice little cup here, pivot entry. So clear that up. So that will be the entry. Now, as far as when I put the trade on, I'm putting an alert right here, and when I get this price, so this price would have been like, let's say right there at 91, 91.30 around there, just above the 89.41. So like somewhere around 90, or I would have entered right here. Where's my stop? Usually I don't want to give up more than 3.5%. So I do trailing stops of 1.5% of a third, 3.5% of another third, 5.5% of the last third. So in this case, technically, if I enter right there, I probably will let it go all the way down to 86.80. And why? Because this right here, I would have taken this previous day's low as my stop loss, which would be the low would be 87.34. If you see there where it says high low, 87.34, That's kind of like my low. So I would have probably got 86, like, you know, 86, 80, 86, 70 around there. So if I'm only taking 3.5% loss and I'm entering a 91, let's say 91, 15. So my entry is 91.15. My stop is 86, let's say 35. That's $4.80. So 480 divided by the 91.15 entry, that's almost 5%. For my initial entry, maybe that's fine in a good trending market. Maybe it's a little bit too much for me right now. So what I would do is, instead of buying 100 shares, I'm going to buy like 80 shares. So you control your shares you're buying based on the math. So if you want to cap it at a 5% loss in this scenario, you can buy 100 shares. If you want to do 3.5% loss, so what's 3.5 of my entry, which is the 91.15, 3.5%, that's $3.19. So that would be 87.96, my stop loss. But that's too tight. I don't want to do 87.96. My stop loss is established technically at 86. So if I do, let's say, 80 shares, that maybe a little bit closer. So you gotta just do the math. You gotta run the numbers and do the math. So you back into how many shares you're gonna buy based on the math of your max loss. Now that 3.5% or 5% or 7% max loss can never be more than 1 to 2% of your portfolio. So if you have a 100-gram portfolio, let's say 1.5%, that's $1,500. That's way too much risk for me on an entry. So if I'm only losing, let's say 3.5%, which is roughly about $300 and some odd dollars, so $350 on a 100-gram portfolio, that's about 0.5%. I'm comfortable with risking 0.5% of my portfolio on one trade. Because if I have 10 trades on 10 stocks, and each one is 0.5%, my maximum risk of my total portfolio is 5%, which is very manageable. I never want to be more than 7 to 10%. I mean, 10% is just like way too much. But let's say max 7%. I try to cut it at 5.5. So that keeps you in the game. So again, I don't want to risk more than 3.5 to 5.5% per transaction, and then that transaction amount should never be more than max 1% of your total portfolio. So you do the math and you back into how many shares you're going to buy based on your maximum risk. So in this case, I'm only risking 3.5%. So 3.5% will give me a stop loss above what it should be. So instead of buying 100 shares, I might buy 80. Make sense? Now, when I say, okay, I'm only buying a quarter position, I'm only buying a half position. Well, again, I'm going back to this. If I'm only buying now 80 shares because my maximum risk is 3.5%, and my stop loss, it's a hard number because that's what it is. I'm only buying 80 shares, so 80 shares times 25%, it's 20. So in this scenario, I might only buy 20 to 25 shares because I'm starting in with a smaller position because my market is choppy and I'm not too confident we're going to trend. So I'm only starting with a quarter position. So that's what that means. Whenever I say I'm starting with a quarter position, I'm starting with a half position, I'm taking my total allocation of this transaction and I'm breaking it down in a smaller chunk because that's what I'm starting with. Now, if it starts working on me, and let's say I buy here first day, I'm buying here first day, quarter position. The next day, this will be where I bought it. This will be my stop. But like, let's say that I would have bought it here, right? And then it goes up on me now, and it doesn't go up more than 2%. It kind of stays above there. I might add on this day another 25% position. So let me go back over here. So I'm buying here. It doesn't do anything. The next couple days it goes up. I might add here because now it's working. And then my stop I'm raising it from here. I'm raising it to this low and so forth. So now on this day I might have 40 shares. About a quarter position here. I'm putting another quarter position here, so now I have 50% position. If it starts working, and let's say it goes up another percent or two, I might add. But in this scenario, I wouldn't have done anything. And now here, when I see this tail, this is a tail bar, I probably would have, had to stop right here. So I might still be in this position because it kind of hasn't done anything, and it's trending this little nine exponential moving average, 9-day exponential moving average. So I'm probably going to trail this going higher, but my initial would have been here. It never violated it. I'm still my 20 shares, 25 shares. I'm adding another 25 shares here. So now I have 40 to 50 shares, and I'm writing this, and my stop is here. That's kind of what that would mean. Let's look at another stock, EOG. Okay, so EOG, I had a trend line here that I probably would have bought somewhere around here, but let's say over here. So 98.20. The second it breaks over 98.20, I'm getting in. So I'm in here, quarter position or half position, right? What's my stop? My stop will be somewhere around here. So 98, 90, 93, that's $3. I probably could afford the 100 shares in this scenario. So I'm buying in this breakout of this base right here. This is my breakout buy. Okay, another earlier entry buy would have been right here. Maybe I buy here. But let's say I'm buying right here. So once I buy here, my stop is right here. Okay, automatically I buy, I put it. That's it. No questions asked. Now it keeps going up on me. Honestly, here, depending on how the market is, I'm probably taking a little bit of profit, or I might be adding on. Now, once I see this bar here, what do? I'm raising my stop to right here, the previous day's low. So now I'm guaranteed a profit. No matter what happens, I'm guaranteed a profit. Okay? This next day, nothing happens. I'm seeing some down days here, but it's still above the 9. I guarantee you, in this day, I'm out. Let me clean this up. So, again, I bought here. Now I added here. I took some profits, and then my stop will be here. I'm out. That's it. I'm out. Now look what happens the next day. Huge down day. I don't want to be involved with that. So what do I do when I'm out here and I take my profits and I move on? I set my new entry, which will be right here, this high. Again, I'm not buying low, guys. I'm not trying to catch the stock when it's going down. I'm trying to catch the bottom here. You're never going to catch the bottom, and you're never going to sell all the way at the top. Okay? So I'm not trying to buy when it's going down. I want it to go down, and I'm catching it when it's coming back up again. So again, this scenario, that would have been a nice entry right there. A little base within a bigger base. So you're looking for that. You're looking for like little tops, little shelf. It's kind of hitting his head, hitting his head. Nothing happened. When it comes back up again, hitting his head, when it does finally break that, boom, you take off. That's trading. This is what you're looking for. You have to be patient. This went from July to September. That's it. You didn't do anything, and you didn't buy. You didn't do anything here. Again, great company. Look at these numbers: 275, 112, tremendous growth. But it's not doing anything. You don't want to be involved in this drama. You're waiting for this to happen. When this happens, look, from this September to all the way, let's say you would have stopped out here to November, you would have made, you would have gone from what, 80 to like 98? Let's say here, 95. You would have made 15 points. That's a nice little, on an $80 stock, 15 divided by 80. That's a 20% return almost. In a month and a half to 2 months. You do that every 2 months, you get yourself a nice little profit for the year. That's like 100% return for the year. That's what you look for. You don't want to be in this mess. You don't want to be in this mess. You want to be, even here, boom, you pick it up and you go. It's like you look for these things. This is like really messy, huh? Okay. Let's go back over here. So again, I know I'm going long on one little thing, but I want to make a point here. You don't chase it when it's going down. You buy when it breaks a new high. You buy when it breaks a new high. You buy when it breaks a new high. That's where you buy it. Okay, here. Let's say you would have had an 86.60 and it went to 87. You would have bought somewhere here. You would have been stopped out here. So you lose a couple dollars. That's it. But you avoid all this. That's what I'm saying. You have a stop and you honor your stop. So again, that's what you do. Okay. Now, how you actually execute it. Let's say you want to buy, so you basically you just buy 100 shares, you put 75.20, you buy it here. Now, let's say I want to have a stop buy. I want to buy it when it does break, like this scenario. I want to buy it when it's 103. Okay, 103 with a new high. So I'll put my number here, 103.01, and then I'm going to put good to cancel, and I'm going to put a stop. So I'm buying 75 shares of stock at 103.01 stop. That means I'm not buying it right now. I'm only buying it if it goes to 103.01. So at 103.01, the broker is going to buy me 75 shares of the stock. That's what that means. Okay? When I want to put a stop is, well, I'm selling 75 shares, and the same thing. A limit order is when you're setting at a price. A stop of, let's say right here at 92.05. So that's when you have a stop. So that means that you own it, and then if it goes to 92.05, you get stopped out, and that's it. You're out of there. That's what a buy stop is. If you want to buy it when it goes higher, and you can't watch the market. Let's say you're working and you're out of the house, but I gave an alert saying like, hey, that if it goes beyond 103.01, I'm buying a quarter position. So you come in, you establish whatever your quarter position is based on your number of shares. You put the price that it had, let's say it was 103.01. I'm buying, and I have a stop. Good to cancel. So that means it's not just a day order. I'm leaving it there for a couple days or whatever it is. So you can go about your day, and if sometime during the day the market hits it, you buy. And then once you buy it, you come in here and you put your stop order at 98.03 or whatever it is. You put your stop order, and that's it. And then you watch it. That's what that is. That's what buying with the stop and the entry points, the trigger, the pivot. And if I want to do a trading stop, okay. So let's say I want to sell it, a trading stop. I put trail stop right here, trail stop, and then I usually have a percentage. So percentage, and I go in here and put 3.5. So now, whatever the price is, let's say right now it's 98.34. So the market's going to trail it 3.5% behind. So as it goes up in price, it's going to trail it at 3.5%. So let's say it goes 3.5%, but then it drops 1%. That 3.5% stays there. It doesn't move down. It stays fixed. So if it goes up 3.5% and it goes back down again 3.4%, I still have it. If it goes down 3.7%, I've stopped out at 3.5%. It goes up 3.5%. It goes down 3.25%. It hovers, and then it takes off 5%. I still own it. So now I'm trading at 3.5%. That's what a trading stop is. Hope that makes sense. And I do it at a third. So I'll do a third 1.5, a third 3.5, and a third 5.5, in case it wiggles around a little bit too much. Okay, so that's what that means, and how I execute that. That's on buying and selling. Okay, now selling a put. In this scenario, I'm looking at this technically, and I'm seeing, okay, well, let me look at NVIDIA. What I was looking at for NVIDIA. Okay, NVIDIA had a low here, and the 200-day moving average is sitting right here. So I did it when I was up here. So I'm saying, okay, I'm thinking this 200 is going to stop. It's gonna hold. So to sell a put, you basically go to your trade here, and let's say I'm doing it for March 26th. This is the call side. This is the put side, and I'm looking at the 200. So The bid is to sell, the ask is to buy. So I just click right here and automatically fills it in. So I'm selling to NVIDIA March 200 put for 520. The natural and the mid, that means like when you have a bid and ask, this is the bid at 520, this is the ask at 545, the mid is the 530. So I usually I go to the mid, or I might go like a little bit more here, and then confirm and send. So I'm going to be getting $1,000 credit on margin requirement of $2,300. Okay, so that's what a naked put is. Now, if you don't have the margin requirement to sell it naked means I'm just selling it outright with nothing else, just a straight selling. You can go here and you can cover it by buying a 190 put. If you hit control, your control key, and then you press it, it'll add it automatically here. Okay, another way to do it is you can go here where it says spread, you could drop down, you can go to vertical. Okay, and then you're selling it, so you're still doing a bid here, and you pick the closest one here, so it puts it, and then you come here, and let's say I want to sell the 200, and I want to buy the 190. Okay, so that's how you do. So you can either go here and do vertical and pick it, and then adjust your prices here, or just keep it as single, and then hit control, and then sell and buy, sell and buy. So I'm selling 200, and I'm buying the 190. See, here it is. So this is going to give me $1.62. Okay, and if I want to do the same two, now I'm going to receive 322 on 544. Remember, before I was getting 1,000 on about 3,000. So obviously I'm getting less credit, but a lot less margin requirement. So you kind of do it based on your account and so forth. Okay, that's what selling a put is. And again, you can cover with a vertical by buying a little bit lower. Same kind of concept. If I want to, like when we did on Facebook, that we sold a call, same kind of concept. So like, let's say over here, what I was looking at is, okay, this, it's all the way over here, down here in the 200s, 230 something. There's no way it's going to get back up here to like, 290 or 300 anytime soon. So I saw the 290. So there will be the call side. So I would sell the 290 here. I got 37 cents. I think I saw like 15 of them. So I just kind of put it here at 37, 39 cents. I would have picked up $500 and something like that. That's what selling the call is. Same kind of concept. If I don't have the margin, I'm gonna hit control key. I'm gonna sell. Bid is sell. Ask is buy. I'm gonna sell the 290, and then I'm gonna buy the 300 to cover it, and the same 15. I would have picked up 8 cents on, the margin is, for me, it's like less margin because I'm on a portfolio margin account. It's different. But that's basically the concept. I mean, again, I wouldn't do this trade. It's not enough credit for 8 cents, but that's the concept. If I'm selling naked something and you don't have the margin, I wouldn't do 5 point, like I wouldn't do a 5 point cover. A minimum always 10. If you could do 15, better, but a minimum 10 strike. So you can have a little bit of wiggle room and you get more credit. Okay? Okay. That's selling a put and selling a call. A covered call. Okay, a covered call is basically the same thing, but I already own the shares. So if I own, let's say I own 100 shares of NVIDIA. Well, basically what I'm going to do with Tesla. I own 100 shares of Tesla, okay? And let's say I sold the 7, I think 85 or something like that, right? So I currently own this. Let's say this stock goes all the way down to 750. I'm going to get this 785 put to me. In other words, I'm going to own Tesla at $785. But I received about, let me see here. I received about $800 for this. I have the 795, sorry. I received 795. And it wasn't even that. It's not that. I have it over here. Sorry. 795. I received, $800. So like, let's say It goes all the way down to 860. This is the date that I have, 5 days away. So it's got to stay above 795 from until next Friday, which is around 795 is somewhere around here. So I'm seeing this little support zone here. I'm seeing the 200-day here. So I'm hoping this is going to hold because based on my technical analysis, and if it doesn't hold, it's perfectly fine. I have the 795. So again, 795. I'm going to get a put to me. So I'm gonna keep the $800 credit. So I made $800. So now I'm gonna own the stock at 795. Okay, and let's say it goes to like 750. So I'm $4,500 in the hole, right? Because I owned it at 795. Let's say it goes to 750. I'm down 45 points. Make sense? I got $800. So I'm not really down 4,500. I'm down 3,700, right? So now what do? I go to the next week, which will be, let's say, 2 weeks away, March 4th, and I own it at 795, right? So I'm gonna go ahead and sell it at 795, and in this particular case, I will sell it at 795, but again, this is at 860, so these numbers are skewed. So let's say I'm down 750 to 790. I'm down 40 points. So 40 points from here will be 900. So the 900 will be the equivalent of my 750, 795 scenario. So I'm gonna pick up about $3,000. Remember, I was down $3,700, right? I'm gonna pick up about $3. So now I'm only down $700. And then as long as Tesla doesn't keep going down, I'm only down $700. If it goes back up to 795, I'll get it taken from me, and then now I'm breaking even, and I made an extra $3,000. I hope that makes sense. It might have come out a little bit convoluted because the numbers don't jive because I'm kind of speculating, the 795 to the 860, but you kind of see what I mean here, where I sell it I'm selling a put, getting premium. If it goes below that, and I'm in the hole, and I get the stock put to me, I mean now I own it on my put strike price, I'm going to turn around and go the next strike out, and I'm going to sell the call side to get more premium. That's called running the wheel, where you sell a put, and if you get it assigned to you, you either roll it or you get it assigned, or you start selling covered calls. Now, another option that I have is I own this Tesla right here. So let's say I want to roll this. Now, sorry, that's not what I wanted to do. This one in particular. Okay, so I own right now the February 18 795 short put. That means I received $500 for this put. Let's say Tesla goes down to like 790 something, or close to this, and I want to get rid of it because I want to get myself some more time, and I want to keep it. I want to make it go low. I want to keep the strike price a little bit lower. So what I do is I roll it. So I buy back what I currently have, and I sell the next week. Same strike, I'm going to get another $700. Or if I want to be more conservative, if I want to go down to 750, okay, I might go another week out. So now I just reduced my risk by 45 points. You see this? I had the 795. I'm rolling it down to the 750. So now I reduced $4,500 of risk, and I'm picking up another $492. See? Credit, $491. So I'm picking up another $491. I'm expanding another week out, and I'm getting another little bit more credit for it. That's what rolling a put will be. What is my other thing here? Okay, Strangle. Strangle is when we did on Netflix and FLX. The Strangle is where I'm selling both the top and the bottom. So I'm doing the same thing as a put naked, but I'm doing the same thing as a call naked. strangling. So I'm selling the 500 and I'm selling the 335. How does that work? Let me see here. Okay. Okay. You can do the same thing. Here, spread. You can go down to strangle. And let's say I'm doing this one right here. It gives you 2. So just pick anything that you want to do. Let's say I start with the call side at 500. So I look for 500 and I do a bid. Bid is when you sell it. So I'm selling the 500, and then the put side, I was selling the 335, right? So I'm going to get a credit of $3. So in this scenario, I'm picking up $600, and my margin requirement is $3,100. Okay? So a strangle is when you're doing both the call side and the put side. The other way to do it is keep it at single, and then you can hit control, and then you pick, I'm selling, bid is selling, ask is buying. I'm selling this one, control, I hit here, and then I scroll back down, still with my control shift key down, my control key down, I go to 335, and I'm selling here. So the same concept, you see? And I'm getting 3 or 4. Now, if again, you don't have the margin to do it naked, because this is naked. I'm naked on the 500, and I'm naked on the 335 put. You can make it an iron condor. An iron condor, it's basically this same thing like we did, but with a vertical here and with a vertical here. So you could do iron condor, or I can go single, and now I'm going to hit the control key, and I'm going to cover my 500 call to 510. And I'm going to cover the 335 with 325. So now I just made it an iron condor. Okay? So that means I have a vertical call short, and I have a vertical put short, and I'm picking up this credit. Sorry, I got to do here. It's 4 and 4. 4 and 4. You got to do it equally. So equally. Equal vertical, equal vertical. So I'm selling the 510, I'm buying the 500, I'm selling the 335, and I'm buying the 325. I'm going to get a lot less credit, like half. Remember, I was getting 3 something, now it's 149, but my margin requirement went down drastically. And it was like 6,000 or something like that. Now it's only $1,100. So this will be an iron condor. If I'm doing a strangle and you don't have the margin requirement, you can make it into a defined risk, which is an iron condor, and this will be the parameters for that. Okay. What was the next thing I wanted to cover? A butterfly. So a butterfly is basically when you sell, when you buy 1, you sell 2, and you buy 1. Wings here, body here. So 1, 2, 1. So the butterfly that I have on Google. Okay, I have the 26. I think it's the 26. Plus 1 put. I have the 2550 minus 2, the body, and then to cover it, I had the 2500 plus 1. So my trade is, and the reason why you do a butterfly is basically it's a directional play. I'm thinking Google's going to go further down, or at least I'm hedging my portfolio for a downturn. So if Google goes down to 26, I'm winning here, and I'm losing in this one, and I'm winning here. But as long as it stays above 550, this one becomes worthless. This one is very profitable. This one is very profitable. So it's a very, very high reward strategy for minimal risk. Because if I'm going to show you what I mean. Okay, so let's say I have it. Let's say in this particular trade, the same way. I'm thinking Google's going to go down to 2600. So I buy the 2600, the put. So it cost me $2,500. And if I do a vertical, and if I cover it with the 2580 here, it's not going to cost me $4.20. Now, a butterfly, same thing. You can go down here, and you can put butterfly. Where is it? Butterfly. Here you go. Butterfly. Here's the scenario. So the one I had, I was doing a put. Again, bid. So, see? 2, 4, 2. So it's 1, 2. This is a selling. I'm buying. I'm buying 2. I'm selling 4, and I'm buying 2. So 2600. 2550. And 2500. You want to make him equal size on the top and the bottom. So 50 points here, 50 points here. So if you remember when I originally bought it, I bought it for $350, so I already have $100 on this. So I'm only spending well, when I bought it, it was $350. So my maximum risk is $350 per contract. So if I'm doing 2, it's this is $923 because this is times 2. If you want to just do 1, you do 1, and then it's just the 460. Again, I already did it for $350, so I'm already up about $100. So like, if Google goes down anywhere near 2600, if it keeps going down, this one is going to expand in price. This one is going to expand in price, and this one is going to expand in price. So I'm making money here, but since I'm short here, it's going to expand in price, but in a negative way. So I'm going to be losing here. But time decay. A butterfly, you buy it with very minimal time. So if Google goes down, this one's going to go up in price because it's going towards this number. But since I'm buying in price here and it's not going down that much to 2500 area, this right here is going to have time decay. And this one here is not really going to do much. It just kind of cover myself so I don't have exposed risk on the downside here. So that's kind of what a butterfly is. Now, when you do a broken wing butterfly, that means instead of having 1, 2, 1, you have the same scenario, but it's uneven, it's broken. In other words, you have 50 points here and 50 points here. On the lower one, I might go to like, let's say 80 points. So 70 points or something like that. Let me see here. So wait, 2550, 2450. So in this scenario, I'm buying it, selling it. So since I'm a little bit more exposed here, I'm kind of shorting this. I'm going to receive a credit. So basically, a broken wing butterfly is when you have the same kind of concept, but one of the wings it's broken. In other words, it has a different strike range. That's what a broken wing butterfly is, and that's kind of how you would do it here. So I kind of went a little bit longer than I wanted to, but I wanted to kind of explain what the different concepts are. Oh, another thing, MT. When I put MT is for market timing. I have a whole bunch of different parameters that I look for and different indicators that I kind of put together into a composite of 1 to 100. So when MT works best on extreme. So anything over 90 is an extreme overbought. Anything less than 20 is an extreme oversold. So if you get to the 20, 15, 10 range, even single digits, we have a very, very oversold market, and we're due for a bounce. I'm not calling it at that particular moment because you can go days on that level, but we're searching for a bottom. And the same thing over 90, I wouldn't initiate new longs over 90 because the market's getting toppy and it's due for a short-term bottom. That's basically what the MT is. So again, I might have gone a little bit too long on this, but I wanted to really, really drive the point across on specifically on the buying entry points. This this trade we did here. I think it was somewhere here. We bought here, and then we took a little profit immediately, and when it started breaking, we took off, and then again here, we bought here, and we kind of sold, took a little profit here, and this trade is still working because this is the daily. It was over here, right here. I had the alert right here. I bought here somewhere, and I took profit somewhere around here. It kept going lower, but then boom. So we avoided all this. Again, I'm not picking the top. I don't want to pick a bottom. I have my trend here, and I'm entering. I would have had my stop right here. I probably would have raised my stop here. When in this day here, I probably would have raised my stop here. I would have taken profits here. And then once it kind of broke over here, I'm out. That's it. Done. And then another entry would have been right here. So let's say another entry would have been, this little top right here. I probably would have entered here. But again, the market on that day maybe wasn't good. So I might not have taken the trade, but let's say you take it, right? Then you would have been stopped out. So let's say you bought it at somewhere here at 227, 226 when it broke. You would have been stopped out like right here at 222. You would have had a 4-point loss. I'm sure this wouldn't have been 100 shares. This probably would have been like 25 shares, 30 shares. So you might have lost $100, But again, we made good money here. Let's say in this scenario, you would have bought the same 30 shares. 195 to 212, yeah, that's almost 15, 20 points that you would have made up by a few hundred, $400, $500, somewhere around there. So the point is, good entries, stop loss, respect it, take profits on the way up, add to your positions if it's 2% above your entry price, another quarter, and then take profits along the way. And keep raising your stops to guarantee yourself break even. And when it breaks it, get out, no questions asked. On the other option trades, again, the option trading is not something that I like to do all the time. It's just we don't have a trending market. We have, we have this. We have this. This is choppy. So when we have this, we're buying shares. When we have this, we can make really good money there. Buying here, boom, stuff like that. You buy in here, boom. You buy in here, boom. Even a little lower entry, you buy in here, even lower entry, you buy in here. That right now, you don't have anything. Let's say I would have bought here, well, you don't have anything. What's my next entry? Even here, I'm buying here. Whenever this happens, I'm not going to speculate. So since it's not trending, I'm not buying shares. I'm not buying stocks because they're not trending. So I'm trying to generate some income with options. Low risk. They're a little higher risk, but they're high probability because we have built-in cushions. So, options have options because you could roll, you could sell a call against it to generate more income. There's different things you could do. Again, it's not my favorite thing to do all the time, but that's the market we have right now. Once we clear here and we start going higher and we have something like this, then I guarantee you we're going to have a lot of these setups. We're going to have a lot of this stuff where we're buying here and we're riding this trend. We're going to have this stuff, we're buying here, and we're riding this trend. That's easy. But we're not there yet. So, we do what we can right now. So be patient, honor your stops. I might have gone a little bit too long in here, but I really want to explain this. Save this video as a reference to kind of a little education on the different things that we do here. And just honor your stops. Any questions, anything you want me to dig even deeper on a particular topic, just let me know, and I have no problem doing a video on it specifically or something like that. Enjoy, and have a blessed weekend.